Hey, Emmett Dempsey with Treasure Coast Mortgage. Welcome back to the channel. In today's video, we're going to talk about how to finance your first Airbnb or investment property. I know that's something that Cheryl and I just kind of delved into. We bought a condo here in PGA Village in the Gulf Villas, and our son lives on one side, and we have Airbnb out the other side. So our 19-year-old son now lives away from home, so he's really just about 2 minutes outside the gate, but still it's good for him, good for us. But for us, we love the investment opportunity. And see the returns that we're getting on Airbnb. It's really just a popular thing that we do. I want to acquire hundreds of them, but how do you do it? So how do you finance them? Today we're talking about 3 ways that you can finance your first Airbnb or investment property. Okay, number 1 are traditional Fannie Freddie financing. They're done for mortgage brokers just like me, so definitely give me a call. So they're done through traditional mortgage brokers. It's generally 25% down. You can get away with 20% down. Actually, technically the minimum is 15% down, but the drastic difference in rates from 15 to 20 to 25% down. So the rates are higher than normal owner-occupied, but how high is high these days? I was doing loans lately in mid-high 3s for investment properties. That was great for owner-occupied rates just a couple of years ago. So the rates are still very, very good for investment properties, so it's definitely a good time to buy. So it's generally, like I said, 25% down. You also have to qualify with the new mortgage and then the new property. But one good benefit of buying investment property that way, you get what's called a 1007 appraisal report. And what that is, it's a market value of rent. So the appraiser will go out there, not only he'll do his appraisal process to do the market value for the sale, but he'll also do a market rent analysis. So for instance, if a property rents for $2,000 a month, they use 75% of that. They'll use a 25% vacancy factor, and they'll give you credit for $1,500 a month to offset that new debt, which can be helpful, if your debt to income is tight. So that's number 1, is the traditional Fannie Freddie financing. Okay, number 2, non-QM loans. I know I did a non-QM video here a couple years ago. I need to update that. It's on my to-do list. But there's a non-QM loan called a DSCR, or Debt Service Coverage Ratio loan, where basically all that matters is the property. It's really the only true stated income loans they have left these days. So if you're an investor with multiple properties, or you have hard to document income, this is probably a good way for you to acquire investment property. So what they do is, like I talked about before, the 1007 rent schedule, the appraiser will give his market assessment, also the rental. So in that prior case, about $2,000 a month for rent. Depending on what the debt service coverage ratio is with the new mortgage payment, taxes, insurance, what have you, there's a calculation that and every lender is different. So you definitely give me a call for that. Based on what you're buying, as long as it covers that debt service coverage ratio, you're able to qualify. Generally, it does require a good amount of down payment and some reserves as well. But this is generally for if you have a hard to document income, or if you have a lot of other investment properties, or you've maxed out your Fannie Freddie financing. Non-QM DSCR loans are a good option to look at. Okay, number 3 is what we call house hacking or house hopping. Now, one form of house hacking is so you can buy a multiple unit property. Now, what we consider single family is actually 1 to 4 units. That's what all your loans are based off of, 1 to 4 units for your single family lending before you get into commercial lending. So single family lending is 1 to 4 units. So you can buy a 4-plex, live on one side, rent out the other 3. I don't know, here in Florida, I don't see a lot of multi-unit properties, but I'm sure other pockets of Florida have them. So you got to check out your market. So you can buy a 4-plex, rent one out. That's one form of house hacking. Or you can buy a single family house, rent out rooms. That's definitely another way. One other way is called basically house hopping. And especially what you do is you buy an owner-occupied property with FHA or 3.5% down, conventional 3% down, or your VA loan. And I did a video about 2 VA loans at the same time, and that's a good strategy to do. So basically, you buy it owner-occupied, you live in it for 6 months to a year, then you find another property to live in, and you just continue the cycle. So you get attractive owner-occupied financing as long as you meet the occupancy requirements, to make sure that you find out what they are, because your intent to occupy, with 6 months to a year, make sure you follow the rules and regulations. But this is a good way to cheaply acquire property because your intent is to occupy, and then you'll move and so on and so forth. And that's basically called house hacking, house hopping, in order for you to do that. Okay, those are a few ways that you can finance your first Airbnb or investment property. Hope that was informative. Here's a few more videos on my channel you might find useful. Thank you so much for watching, and I'll see you on the next one.